despite this high interest rate, the inflation still sticky. Sticky by it means also means stubborn, which means that we can see that over the past 6 months, despite the inflation data coming down all the way to 3.2%, but now it's going sideways over the past few data points. It has been range bound around 3% since January. Based on the January data until now, it has been range bound around the 3% region and is going sideways. Hence, if let's say the inflation situation prolong, the Fed may change the decisions as we are getting towards mid-year and so on. I'm Chye, a financial market analyst and coach at Beyond Insight, and this is your express session to get up to date with the stock market. Since we are doing this over lunchtime, hence we will keep it to 30 minutes. I will start the timer when we start. We will cover the market highlights, major stock market indices performance, and the upcoming potential opportunities and risks out there. So are you guys ready? You may type me in the chat if you are ready. You may type me in the chat if you are ready. So let me start the timer. All right, just before we start, just an important note before we proceed. Whatever we share here today is based on the latest data and facts. If there is further development, things may change. And we want to make sure that you know we are not a licensed investment advisor and we do not manage customers' fund. We are educational institution, so our purpose here is to educate people so that you can make your own decisions and be your own investment manager. That way, you have a better control over your decisions and hence be able to get better results. If you are looking for stock tips, this is not the place for it. All information we share here are meant for educational purposes only and must not be taken as a recommendation to buy or sell. All right, let's move on to the next slide. So as usual, let's start with the market highlights. How many of you have been active in the stock market over the past months? You may type in the chat. If you are active in the stock market, you can type me in the chat. Any one of you active in the stock market over the past month? All right, Jacqueline, Arthur, Susan. All right. So how was the market performance over the past months? Volatile, all right, volatile. Okay, so in our view, the stock market created new highs again for the stock market after the FOMC, after the US Central Bank meeting. And one of the reasons is the market reacted positively to the FOMC statement after the Fed maintains the target rate despite the sticky inflation. So in earlier uncertainty, where inflation is still high, market expects the Fed may not cut the rate so soon. However, during the FOMC, during the press conference, they do give some positive outlook on the rate cut view, and also at the same time, based on their projection, market anticipates potentially 3 rate cuts in 2024. Hence, the market rallied after the statement by the FOMC. This is because despite inflation higher than expected, based on the projection from the Fed, they still foreseeing a potential 3 rate cut in 2024. And can the stock market rally last? So is this the answer this is the answer most of the traders and investors looking for? And from our analysis, the US stock market rally has been backed by the following few factors. First of all will be the potential rate cuts by the US Central Bank, which is also known as the Fed, in second half of 2024. So this is based on the projections the Fed provided during the FOMC for month of March, and the data may change in future. However, overall, the market took it positively, and overall market participants, the buyers and the market participants also foresee that potentially the rate cut may happen second half of 2024. And the second point that's supporting the stock market rally would be the artificial intelligence trends among tech companies. So the artificial intelligence mega trends are real. Those companies like Nvidia, Microsoft are churning out earnings results, seeing a huge growth in data center and so on, and riding along the AI trend. But however, beware of the competition in the tech industries as more and more companies start to roll out their AI solution, and we'll see more competition in the future. And what traders can do. All right, so as a traders or investor, we shouldn't simply buy or don't buy immediately. We need to have a plan, a set of analysis and plan according and trade according to the trading plan or invest according to the investing plan. Investor may need to wait for temporary setback or a pullback in the stock market for entry opportunities at good valuation, as currently the overall market valuations already at the high level, which is on the expensive side. And the upcoming and also traders may also need to wait for pullback or the right setup before enter any positions for trading purpose. And the upcoming April's earnings season, which is next month, may fuel the rally further should companies report strong earnings. So despite the strong uptrend, traders can still trade. However, for investors may need to wait for a pullback. And despite I'm saying traders can trade, they may need to wait for a right patterns or right setups to trade. All right, so let's move on to the next topic. So let us take a look on the stock market performance comparing different countries and also indices. So from the list here, we can see that the Nasdaq 100, which represent the top 100 US tech stocks, providing a return of average 10-year or return of 418% over the 10 years. And the average per year is around 41.82%. And if let's say we take a look on S&P 500 as well, which is representing the top 500 stocks in the United States, it gives a return of like a double-digit per year return as well. The stock market in the US has been trending up since second half of 2023. However, it's likely due to the strong catalyst from, like I mentioned earlier, the Fed, and also at the same time, we do have AI catalyst in the tech sector. Hence, it triggers the rally second half of the last year onwards until now. But it does not mean that we can buy immediately. Investors or traders, like I mentioned earlier, need to have a plan and enter according to the plan or enter according to the entry criteria you define. Currently, the market is already at a high level, so the valuation also is at a high level. So investors or traders can wait for any negative sentiment or any temporary negative setback from the stock market, or a pullback will be a good opportunity to get into those stocks with strong fundamental and also high growth, and also with the AI trends and so on. So you can screen for those stocks that are having catalysts, for example, like the AI megatrends, or screen for those companies with strong fundamentals. So when I say screen, means that you are searching for, you are filtering those good stocks and add it to your watch list, which is you are going to monitor. And next will be the China market. Despite the Chinese government over the past months, especially after Chinese New Year, have applied a lot of monetary and also fiscal policies recently to recover the economy. However, with all these stimulus, all these fiscal policies, we do see that the stock market likely will be bottom. However, it does not mean it will immediately turn into a bull market. Because why? Any one of you aware of what happened in China over the recent months or over the past few years? How was the economy doing and how was the stock market doing in China? Yes, US tension. And also at the same time, they have this high unemployment. They have also having deflation issues in China. They also having property crisis, and also they are facing funds outflow issue where a lot of factories are moving out from China and potentially move to the Southeast Asia or India, or even go back to America. So this is a very fundamental problem that China need to solve, and we do foresee that it's not an easy problem to solve. Hence, it may not turn into a bull market immediately. It may consolidate sideways for a while until we see much more improvement over the situation there. And thirdly will be the Hang Seng Index. The next one will be Hang Seng Index, Hong Kong. For Hong Kong, they took a double whammy, which they exposed to the US market as well, and also at the same time, they are affected by uncertainties in China. Hence, you can see over the past few years, the Hong Kong market has been going on for sideways for a while. And lastly will be the KLCI, which is the Malaysian market, which sideways for the past 1 month after it recovered strongly early of this year. So for Malaysia market, the key factor will still be economic growth, and also the continuation of the recovery will be rely on the foreign investment. Hence, one of the key indicator for us to monitor for Malaysia market if the recovery able to be sustained will be the foreign funds inflows, and also at the same time, how is the economic growth doing? How is our economy doing? Having said that, there are still some fundamentally strong companies in Malaysia. So from the overall comparison here, over these 5 charts, which market provide the most consistent return? You may type in the chat, which market provide the most consistent return? Yes, US. So for trade investor and traders who are looking for high growth, the US market will be having more high growth companies that are having these greater brand names, and also having strong drivers, for example, like AI, cloud computing, and even next gen broadband. So any AI or cloud computing brands you heard from the US, you may type in the chat any AI or cloud computing brand names, or any strong brand names you heard from the US market. You may type in the chat. Yeah, Microsoft, we have Microsoft, Nvidia, Google, Amazon, and even Apple, your iPhone, and also Tesla, the electric car, and so on. So you can see that companies in the US are having higher earnings growth compared to other countries, and also at the same time, they are global brands, which means that they export their products to the world, they sell their product to the world. Hence, they also provide more predictable returns because the customer base is bigger, they are selling to worldwide. All right, other than the few catalysts or few factors I mentioned earlier, there is also money on the sidelines. So based on the latest information we have from the money market funds, which is similar like our FD, which for most of the funds in the market, usually when they are in cash position, they will park the money to the money market funds. This work like our FD, they will provide a fixed interest rate over the time. So one of the reasons why investors are stocking up or parking their cash in the money market funds is likely due to the high interest rate in the US. So anyone of you here know what is the current interest rate in the United States? You may type in the chat. Yes, 5.5%. So part of the reason why is because they want to take advantage of the current high risk-free rate due to high interest rate in the US. Hence, they will park their money in money market funds, especially US money market funds, and earn the 5.5% risk-free interest rate. So we do see that when the rate hike cycle is nearing its end, this massive 6.3 trillion pile of cash potentially could act as a fuel to drive the next bull market in the stock market, or they may rotate to the bonds market to lock in the higher yield rate higher yield before the interest rate reduction. So this is currently we are at a transition point where the Fed already stopped hiking interest rate, the rates already peaked, and is depending on when the Fed will have the first rate cut, and the first rate cut will be highly dependent on the inflation data. So what do we focus? What to focus next for investor or traders? So usually as a responsible investor or trader, we will evaluate the risk first before we checking the potential opportunities. But before we go into that, what are the 3 major themes I mentioned earlier for first half of 2024? What are the 3 major themes I just shared? All right, so no one answer, but it's okay. So first of all will be the rate cut, and second thing will be this AI mega trend. And thirdly will be geopolitical tensions, which I will cover during the risk part. So first of all, let's take a look on the potential risks out there. over optimism on rate cut. So currently, despite overall market expect there will potentially 3 rate cuts from the Feds, but this is just the market assumption. During the FOMC, the Fed do mention that they still would like to go for a data-dependent approach, where they want to see the upcoming inflation data before make any rate cut decisions. However, the positive side will be their projections, where they project the year-end terminal rate for 2024 is around 4.6%. Hence, the market expects that from 5.5% to 4.6% for year 2024, there is potentially at least 3 rate cuts. So this is solely the market interpret the rate cut based on the projection provided by the Fed. And the second thing will be the inflation reduction sustainability, whereby currently we already at 5.5% interest rate, and the inflation, despite this high interest rate, the inflation still sticky. Sticky by it means also means stubborn, which means that we can see that over the past 6 months, despite the inflation data coming down all the way to 3.2%, but now it's going sideways over the past few data points. It has been range bound around 3% since January. Based on the January data until now, it has been range bound around the 3% region and is going sideways. Hence, if let's say the inflation situation prolong, the Fed may change the decisions as we are getting towards mid-year and so on. So do monitor the coming inflation data because they may move the market big time. And thirdly will be geopolitical tension. So how many wars we have now in this world? Currently, as of I'm speaking now, how many wars are still ongoing? You may type in the chat. Yes, 2. We have the Ukraine-Russia war, and at the same time, we also have the Israel and Hamas war. And at the same time, the side effects for the Israel-Hamas war will be the Red Sea crisis, where it will cause high inflation in the Europe region, likely to cause high inflation in the Europe region because it will affect the logistics, will affect the shipping lanes in the Middle East, especially Europe region, where they need to ship big machinery or big machinery products or big vehicle products. For example, like Europe are the main car exporter. They need to ship their products via the Middle Eastern route through the sea. And all these heavy machinery, heavy equipment, shipment may be affected due to the Red Sea crisis. And also at the same time, in Asia, what geopolitical tension we have between China and US? What is the geopolitical tension we have between China and US? You may type in the chat as well. Yes, we have the trade war, we have the US-China tech war, and also at the same time, we have the Taiwan issue. All right, so for this China-US tension, it will likely to stay there for maybe more decades or more years. Hence, as a traders or investor, we need to take note of this as a potential risk. And when we invest our portfolio, we may need to reduce the exposure to companies that highly dependent on China, or reduce the exposures that highly dependent on Taiwan and so on. So we may need to monitor the situation, the geopolitical situation. However, we also don't want to be over conservative until not invest at all, because there are still plenty of opportunities out there despite all this geopolitical tension going on. So just avoid over investing in those companies with high exposure to these regions I mentioned. And lastly, for the risk part will be slower consumer spending recovery. So as we know, China currently in economic crisis mode. I would say they have a significant slowdown in terms of their property sectors, in terms of their economy, because we do see that their inflation now is at 0.7% if I not remember wrongly, and just recovered from minus 0.7 deflationary situations. Hence, we will continue to monitor the inflation data in China as well, because if let's say inflation too low, it may not good for the economy as well, because it also shows that the economy are slowing down, demand are slow, demands are low, people are not willing to spend money. And also at the same time, in the US, the high inflation may slow down the consumer spending recovery as well. Currently, the inflation in US still at 3.2%, which is on the high side as well, and it may affect people's spending power, spending plan. People may reduce their discretionary spending, hence it may slow down the consumer spending recovery. And also in the past, we do talk about PC demand recovery, and with the high inflation, PC demand recovery may be delayed as well. So this may affect companies that like AMD or even Intel, because what do you think PC belongs to? Discretionary spending or an essential in this case? Discretionary. So when inflation are still high, people are still worrying about their essential spending where things are getting more and more expensive. Hence, it's quite normal overall people are cutting their discretionary spendings. Hence, PC is a discretionary product. Hence, the recovery may be delayed because the upgrade cycle, in the past, we do mention about the upgrade cycles every 4 years to 5 years. The laptop will obsolete, the smartphones will obsolete. And in this case, people may hold on another year before they upgrade their laptops. Hence, the PC demand recovery may be delayed due to the higher inflation than expected. All right, so after we go through all the potentially risks out there, then let's take a look on the opportunities. So there are still industries aligned with the key themes, for example, mega trends like AI, cloud computing, and so on. And all these companies actually churning out earnings result over the past few months. We can see that from NVIDIA's earnings report. We can see that from Microsoft earnings report. And also at the same time, there are still other key mega trends ongoing. For example, like big data, like clean energy, and also next-gen broadband like 5G and even 6G. And another potential opportunities we see will be the industry recovery, about the server demand recovery. So during the AI boom last year, which for NVIDIA, let's say for example NVIDIA, so what kind of chips are selling well? What is their main revenue coming from for the chip sales? Which type of chips that providing the major revenue? Anyone of you that familiar with NVIDIA? Yes, GPU AI chips. So all these GPU AI chips has been used in the data center, and before they introduce more AI products, for example, let's say Microsoft want to introduce more services of ChatGPT or AI services to their clients, they need to upgrade their data center. They need to upgrade their servers. They need to have high performance computer to calculate to train the AI, to calculate the complex formula, to solve AI problems, or to train the AI to have these machine learnings and so on. Hence, all these companies are spending capital to upgrade their servers, upgrade their data centers. Hence, they are buying a lot of NVIDIA's chip, and NVIDIA's chip are actually the most powerful AI chips for now. They are the leaders. Hence, you can see that the revenue growth for data center for NVIDIA is significant over the past year. Hence, we do see that the server demand recovery will continue on. And this year, those major players for AI will continue to upgrade their data center. Hence, all these server manufacturers are benefiting from it. And also all these chip makers like AMD, Intel, and also even NVIDIA that's selling GPU, especially NVIDIA that's selling GPU, are benefits from this trend. And we are also looking at the second phase of AI, where it will roll out to the consumer sides. So we do see that through the second half of 2024, you may see more AI smartphones, you may see more AI laptops introduced to the consumer market as well. Hence, we do see that the AI growth will be a big one, a potential big growth for a potential big mega trends for upcoming few years. And the second opportunities will be companies with low debt, low exposure to bonds, and also strong cash flow. So this one point towards those companies with strong fundamentals, strong balance sheet, strong cash flow statement, and also strong revenue, strong financial record, and having low debt. Why we advocate low debt company will be an opportunities, because during high interest rate, do you think it's easy for a company to service a debt if let's say they are in high debt situations? You may type in the chat. Is it easy for a company to service their debt under high interest rate environment? No. So hence, if let's say as an investor, you may go for those companies with lower debts, lower exposure to bonds, and also strong cash flow. And thirdly, we do see that recovery for consumer discretionary as well, mainly on travel, credit services, and also real estate. With the rate cut themes in play, real estate likely will benefit from it due to the lower interest rate, because I think currently in the US the mortgage rate are quite high, and if let's say there is a rate cut factors, it will be positive factors for the real estate segment. And for travel and credit services, post lockdown, now worlds are opening up, people are start to traveling again, and also at the same time with all this travel, people are traveling around the world, then credit services will doing well. Credit services refer to companies like Visa and Master. So why, when travel recover, why Visa and Master will benefit from it? Anyone would likely will benefit from it. Anyone would like to type in the chat, what is the major transactions for Visa and Master coming from? What are the major transactions coming from for MasterCard and Visa? All right, e-wallet and all this. Yeah, most of the transactions for Visa and MasterCard will be coming, likely majority of them will be coming from travel. For example, when you travel, you buy the air tickets, you book the hotels. Yeah, all this spending will coming from travel expenses. The big spending for the Visa card and MasterCard will be likely will be coming from all these flights, hotels, and even retail when you are traveling, when you are spending. Hence, we do see that a potential recovery for consumer discretionary, especially for travel, credit services, and also real estate. And also company with lesser revenue dependency on foreign markets, like I mentioned earlier, geopolitical tension, or especially China and US. Hence, when we are selecting a companies, we may look for those companies with lesser revenue dependency on foreign markets. For example, those companies like Nike and also Starbucks, they are having high exposure to China. Hence, recently from the stock charts, you can see that temporarily they are not doing well. However, they are still good companies. You may continue to monitor their fundamentals, and they may recover in the future if let's say the situation in China recover as well, and if let's say they have other method to capture other countries' market shares. However, for the opportunity part, we do mention that we still stick with company with lesser revenue dependency on foreign markets, especially those high exposure to China ones. Hence, there are still companies that are quite balanced. For example, Microsoft, their revenues are quite balanced. They are balanced between the US and also Europe, and they are also benefiting from the AI mega trends. And lastly, the opportunities lies will be money on the sidelines. 6 trillion in cash on the sidelines in the money market funds, like I mentioned earlier, and potentially they may come into the stock market or bonds market when the rate hike cycle is over, when the Fed start to cutting interest rates. Those funds may rotate from money market funds towards all these stock market and even the bonds market to lock down better rate. All right, so with all these opportunities out there and all these potential risks, we do see that there are still plenty of opportunities in the stock market, and currently the stock market is at a stretch level, like I mentioned earlier. Any pullback will be an opportunity to enter stocks that are related to the mega trends. And let's say if you are a fund manager, let's say funds are moving out from China, like I mentioned earlier. Which market likely the funds will move to? Yeah, may move to India, may move to Southeast Asia region, and also may move back to the United States. With all these fiscal policies going on in the US as well to encourage all these semiconductor opening fab in the US as well. And while waiting for the pullback, you may take this time to learn up the skill set and capitalize on the upcoming continuation of the stock market rally. And we do see that opportunities will outweigh the risk. All these risks, for example, like geopolitical tension, will likely be going on for years. As long as we manage the risk properly, it will be all right, because we have a systematic way to manage those risks, right? And the stock market is still the best instrument to generate higher returns than the inflation. And the stock market still, provide greater returns, still the best instruments to counter inflation. And the stock market, US stock market, still has the most consistent return and also high quality companies to invest in. And the US economy currently also have the strongest growth among all these big powerhouse. US GDP has been doing well over 2023 against the Europe, and also at the same time, even though China GDP is still high, but the growth are slowing down. Hence, the US economy is still the strongest worldwide for 2024. Despite you see a lot of news about global economy slowdown, the US GDP still are the one that are growing in 2024 based on the projection from the Fed as well. And the market already recovered now, and like I mentioned again, the stock market now is at a stretch level. We doesn't mean we can buy immediately. We need to wait for the pullback, and while waiting for the pullback, we can sharpen our skills before we while we are waiting for the opportunities. And having said that, the stock market are bullish. Having said that, we want to do it safely and systematically. We have the most systematic course in the market, where we have processed that for every trading style. We have versatile strategies to handle all market conditions, and we have safe approach with proper risk management. And you need to plan in some time to practice and pick up the skill set while waiting for the opportunities. And get yourself ready when the opportunities come, when the pullbacks come, when there is a temporary setback in the stock market or temporary negative sentiment in the stock market. That will be the best opportunities for you to capitalize, go into all these strong fundamental company. Since this is just a 30-minute market update, we would like to invite you to a free 3-hour webinar that covers a framework on how to approach the stock market in a systematic, versatile, and safe way. Also, we have a hybrid class for the coming intake. We have face-to-face. Hybrid class means face-to-face and also online, happening concurrently, where you can choose to join either face-to-face or online. And we only have 30 minutes for this market update. If you like to find out more, do join us in the 3-hour webinar to find out more. You can scan the QR code to understand more about the free webinar. The next available webinar will be on 30th March, which is a Saturday, 9:30 a.m. If you find this market update beneficial to you, do recommend it to your friends. All right, so that's all for my market update. I will now open the floor for Q&A. So if you have any burning questions, I already come out in the chat. I see plenty of questions. So first of all, should I trade cautiously? Because market seems overstretched, but at the same time, investors are anticipating a rate cut. I would say market currently at a stretch level. Do wait for a pullback first to form a better support before you enter your trades or you enter your investment. Do wait for a pullback first. Do wait for the right valuation for the stock you are looking for, and also if let's say you are trading, do look out for the right setup, the right support before you enter your trading position. And second question, may I ask, the recent China block use of AMD and Intel is considered a temporary pullback, or we shall stay away from these two stocks and monitor them? All right, and what with the recent China block of AMD and Intel, is this something that could have changed the company's strong fundamental? I would say, all right, so for AMD, other than CPU itself, what other kind of chips AMD produce as well? All right, they do produce GPU as well, and they are the alternative for NVIDIA, which they're providing a also providing AI chips for all these data center. And the most data center boom are happening in the US. And China, despite China recently banned all these banned this CPU from government usage, I do think that the private sectors are still going using the Intel and AMD CPU. And according to our understanding, the AMD exposure to China is around quarter of the companies, one quarter of the revenue from China. And I do see that the growth in US potentially still able to cover the setback. However, if let's say you comparing both of these Intel against AMD, I would say Intel will be more affected because they are mostly on CPU business, and do monitor the stock charts reaction to the news as well, whether the support still holding. But currently, I think fundamentally AMD is still in a better position compared to Intel, if let's say saying about the China block, especially blocking the CPU usage for the government department. But I do see that the private sectors may still continue with the Intel processors, and those laptops from China for now, like for example, Huawei laptop are still using Intel chip that's selling to the Asia market and so on. So I would say we may need to continue the impacts over the next few quarters, but I do see that in terms of landscape, AMD still at the better positions due to they have a stronger AI chips compared to Intel for now, the products for now. But if let's say Intel in future will launch any new products about AI, it may change the market situation. But for now, the loss in the CPU market in China may able to be covered by the growth in the data center in the US. Okay, then the other question will be, once the US rate cut, would the US stock pull back or crash? What is your prediction? So I don't have a crystal ball. I don't see a major crash coming. I cannot see whether a major crash coming. However, as an investor, we focus on those fundamentally strong stocks. We draft out our own trading plan, our own investment plan, and we trade according to our plan and also trade according to the trends of the market. We do have one skill set called technical analysis, where we will check overall trends, and also at the same time we monitor the market sentiment, the macro sentiment, and also at the same time we select all those great stocks, great companies, great fundamental strong companies that are increasing our probabilities. So we don't know the future. We just need to manage the risk. The risk will always be there. The risk will always be there. We just need to manage the risk. For example, we have a cut loss. We determine a cut loss before we enter. We predetermine where is our exit point before we enter a positions, and we enter at a better valuation or we enter at the support level. Hence, if let's say the stock market crash, we don't know whether they will crash in the future. Definitely, there will be a crash and a lot of doomsday sayers in the market. You may heard about the market crash and so on. But as long as you manage your risk well, you just stay invested, select those great companies, enter at the right valuations, and manage the risk properly, and trade responsibly, which means that don't over invest or don't over expose your assets. So this is how you can approach the market, because we cannot predict that what will happen next and will there be the market crash in coming 6 months or 1 year. I don't have a crystal ball to predict that. As long as we manage our risk well, we trade according to our plan, things will be working out with for us with all these high probabilities companies, so those strong fundamentals company. All right, another question. What about Vietnam and India market? All right, so Vietnam and India beneficial from all these funds outflow from China, where you can see that Vietnam having a great boom in their stock market indices, as well as the India market also keep breaking on new high. However, those companies in India and Vietnam are less reputable, and also I think the stock market over there also less global brand names and so on. So if let's say you are interested in India or Vietnam, you can research more about the ETF offering, all these funds offering all these index ETF that are covering Vietnam and also India market. However, for individual company, there are less reputable companies out there. Okay, so which bond or stock do you recommend? So we are not recommending any stock or bonds. just go through as long as you select those strong fundamentals company and so on. Yeah, things will work in your favors because strong fundamentals companies are designed to break resistance. They are designed to trend up according to their earnings, according to their revenues. However, temporary market sentiment or temporary market setback may pull them down in a very good valuation. That will be the good time for you to capture all these strong fundamental stocks. So, okay, so some of you may I ask the difference between ASML and ASMLF? So ASML is a Dutch company that listed in the US. They are mainly doing machinery for all these wafer fab. And ASML is the ticker that listed in US. ASMLF could be the alternative ticker symbol that are listed in other place else. So if let's say you are invested in the US, the tickers I know of will be the ASML. ASMLF, unfortunately, I'm not sure which ticker or which symbol this will be listed in, but I suspect there will be ASML is the one that listed in the US you should looking at if let's say you are trading in or investing in the US market. Okay, all right. So I see one of the could be a student question from our student, is still safe to do P1 or P2 swing trade in the current market? All right. So currently the stock market valuation at the high side. So I would say swing trading will be still one of the favorable styles. You can still do all these patterns you learn, pattern 1, 2, 3 in the workshop we covered. You can still apply these strategies, especially currently market at a high level where there is all these great stocks already at a higher valuation. This is the best time for swing trading because with high valuation, there will be not much investment entry because higher valuation now. Hence, it's the best time for you to do some swing trading as well as the market going sideways or the momentum of the uptrend slowing down. You can still do all this swing trading and so on. All right. And any tip to trade safer? I would say still manage your risk. Make sure you follow the risk management process. Make sure you honor your stop loss. Make sure you trade according to your plan. All right. I have covered quite a lot of questions here, and I think it's coming to 1 p.m. now and 1 p.m. plus 10 minutes now, and my clock also is counting towards 0. So all right, so with that, this is the end for the market update sessions. See you in the next month's market update, and if you find this market update is useful, do recommend it to your friends. All right, see you all again. Bye bye.